was this just inevitable? I mean, it seems to work out both for the companies and the investors.
Right. Right now, when we are in a world of pretty much record low yields in investment grade credit, it makes a lot of sense that these companies would say, I want to issue debt as long as possible. And on the flip side, if you're an investor, a longer dated bond is going to offer you a little more yield than something in maybe, say, the 5-year range. However, are you willing to accept those greater risks of lending money for 30 years instead of just 5 or 10?
So, Claire, what did you discover about the appetite, where it's coming from? I mean, are we talking about pension funds who have that long-term thinking?
Yes. So when you think about who buys these bonds, the traditional buyers are definitely those pensions, those insurers, pretty much anyone out there who has a need to sort of match their assets with their liabilities. That being said, we talk to a lot of investors who say, I really have no choice but to look at some of these longer dated securities. And that's just a result of companies saying, I'm going to bring these longer bonds, and if you want to get yield, you have to buy them.
So the downside to investing in these longer-term bonds, we have seen Kraft Heinz, for example, being cut to junk, right? So during a longer period of time, there are more risks. So what's the average borrowing time now?
Yeah, so when you look across the investment grade index, we are at an average duration of more than 8 years, and that has been steadily ticking up over the past few years, just as rates have been so low. One of my favorite stories about this is J.C. Penney, now a distressed retailer. Back in the 1990s, they came out, they were investment grade, they did it in a 100-year bond. We don't see many of those.
Yeah, you don't know how the retail landscape will change in the next century.
Yeah, so that's the risk there, right?
And Claire, just to bring it back to the Fed, which we were talking about earlier, when we're talking about these long-dated bonds, could they be a wild card in all this over the longer term?
Definitely. We don't really know where rates are going to go. And one of the big risks of these products is that when you're looking at a longer duration bond, that has a lot more interest rate risk. So, let's say it's a few years from now, rates are higher. Those bonds can really get whacked. We ran the math. A 40-year bond, if the interest rates rise by 1%, you could essentially lose 20 points on that bond just with that interest rate risk component.